Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Nick Barisheff, Tom Luongo, and Ira Harris. Nick is the author of $10,000 Gold and the founder, president, and CEO of Bullion Management Group, company dedicated to providing investors with purchasing and holding physical bullion. Nick has written numerous articles on bullion, current market trends that are published on various news and business websites. He's appeared on BNN, CBC, CNBC, Sun Media, has been interviewed for articles published in leading business publications across North America, Europe, and Asia. Tom is an Austrian school economist, former research chemist, who contributes to Seeking Alpha and Newsmax Media, among other media. He is the owner and publisher of Gold, Goats, and Guns newsletter. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also recently. Welcome, gentlemen.
Thank you for the invite, guys.
Thank you.
Thank you, Richard.
Great. I thought we'd begin with today, August 5th. What a day in the metals markets. Gold, silver, platinum, palladium, copper, all up big today. What is driving these markets higher? Begin with Nick. Your thoughts?
Well, I guess the past 2 days are the bombing in Lebanon, and typically when you have events like that, a rise in the gold price is short-lived. But in this case, in Lebanon, because the country was in deep trouble before, it was virtually on collapse. But now there's 300,000 people homeless. The port that is the main port to import food and so on has been destroyed, so they can't bring in any more food. And part of the thing that was destroyed were the silos that held all kinds of corn and grain that's got destroyed. So this is going to end up being a long-term problem, and some people think this will escalate into an all-out Middle East war, because they're going to blame someone for this. And then it's going to accelerate. So that could have a longer term effect. But the main effect that's always been is when the central banks print money and debase the currency, and it's starting to become at an accelerated rate where we're going to come close to looking like Zimbabwe, because so far they've printed the money and given it to people not to work. Come the fall, they're going to have to give it to businesses and individuals in order to try and boost GDP. So the current increases, many people think they'll be, the Fed funds will be in the 20 trillion range by year end, and I think we're going to have so many businesses fail, because the lagging effects of all this lockdown and everything, people are just not going to return to their, shopping habits and consumption habits that were in place in March. So I think the money printing is going to be the main driver of the gold price, and I think my estimate of $10,000 gold is starting to look conservative.
Interesting. And your thoughts, Tom?
I'm not going to disagree with anything Nick just said. I'm going to say the only thing I have a little worry about at this point in time is that gold looks like it's getting a little bit ahead of itself. The same thing with silver. So in the short term, I'm firmly convinced that we're going to get some kind of interbank market spasm was similar to what we had in September of 2008. That's kind of if you look at the timeline that we've had since September of last year when the repo markets first seized up, when SOFR blew out to 11%, and then we had the market seize up in March, and then that's analogous to the same timeline we had in 2007, 2008. So, and we have an election coming up, and a whole bunch of people dead set on getting rid of Donald Trump. So the best way to get rid of Donald Trump is to crash the markets or allow the markets to crash. And right now we're in this moment where all of the Fed's emergency measures, liquidity injections, have all been removed from their balance sheets. In the last couple of weeks, we've seen the current foreign central bank currency swaps drop down by about $300 billion or so. There's no outstanding repos sitting on the Fed's balance sheet, at least as of about last week. I haven't checked it in the last 10 days or so, but all those stresses went away. And then with all that dollar hoarding, and then there was a whole bunch of dollar hoarding, and we've gotten a little bit of dollar dishoarding. And while we're kind of between crises, as it were, waves of this crisis, and maybe the best way to look at it, since we're in hurricane season and I'm in Florida, it's the best way to look at it is we're in the eye of the storm, and the next eye wall is coming, and it's anywhere from 3 to 6 or 12 weeks out. And when that happens, we're going to see another seizure in the financial markets, and we're going to get into another sell everything to raise dollars mode for a few days or a few weeks. And then I expect gold and silver to correct, but then explode to the upside. And the same kind of false move down that we had in gold and silver back in March, when silver hit 11, gold pushed down to about 1450 or so. And then immediately we saw V-shaped bottoms in them. So, and then in the long run, all the things that Nick talked about, the fundamentals are insane. We can even dig in, I think, a little farther than that. But Ira, your thoughts on this?
Well, Tom, I think when we did our podcast not long ago, we talked about a lot of these things, and Nick points out there are many things. And if people listen to this conversation, they'll of course say, well, what am I listening to? Gold bugs in the most derisive term. And my response always back to them is, well, are you a fiat currency bug? So, this is about fiat currencies.
Right.
And the fact that central banks, and I can't say enough, are just losing their credibility. While the equity markets applaud, because, again, the free money levitates those assets all over the world. So they applaud it, but nobody looks under the covers. Nick is looking under the covers and goes, well, I see what's coming. And I think we all agree on that. We're on the Financial Repression Authority. So we see what is taking place. I know how long it takes to play out. Don't know.
Right.
I don't pick targets. And as people say, you love gold. I said, it's not that I love gold. I would love to see gold. And I think, Tom, you and I talked about this. I'd like to see it at $41. But that's not happening because the monetary policies over the last 12 years, 13 years have been so disastrous. And now we're getting to coupling with fiscal policies, which really were missing for a while, but they're full throttle now. And that's going to create, as many people have pointed out, and I know Tom's piece on quantitative monetary theory, you are now, once, as Nick pointed out, because when comes September, October, you are going to get some velocity to this money that we haven't had before.
Right.
I'll bring in Tom's piece because he talks about, especially, and it's something that I've talked a lot with you, Richard, and certainly with Santelli, and people's eyes would glass over because, those who are always bashing gold as an investment, where's the inflation? And I say it's not an issue of inflation. I've been adamant about that for 20 years, 25 years. It's not an issue. It's about credibility of central banks.
Yes.
And you get the inflation, as Tom's really good article points out, because of the interest on excess reserves. And if there's a plus to Judy Shelton, if I can digress a little bit, becoming a Fed governor, it's because she brings up the issue of interest on excess reserves, and it needs to be discussed in a real way that it hasn't been. So, people say, well, are you in favor of Judy Shelton? No, there are a lot of things I disagree with her vehemently about, but it would at least make the conversation interesting.
Right.
Mm-hmm. Well, the other, which I've often said, is kind of the elephant in the room that many people aren't focusing on is the fact that China purports to have 1,500 tons of gold, but many analysts have looked at this and they believe China has well north of 5,000 tons. And the issue is that China buys its gold in a sovereign wealth fund that doesn't report anything to anybody. And they can transfer the gold from the sovereign wealth fund to the central bank anytime they please. Now, they're not going to do that until they've got enough gold, and their stated intent, not a secret, is to have more gold than the U.S. So the thing that has a real likelihood of happening, and at some point in time, when China has enough gold and they announce that they have 10,000 tons of gold, the question is going to be, where did they get the gold from? Because the reporting agencies like GFMS and CPM have reported on the supply-demand down to, every fraction of an ounce. And the only place that they could get to 10,000 tons of gold is leased gold. That's being leased and is never coming back. Now, if that happens, and that'll be clear that the U.S. doesn't have 8,000 tons that they purport to, and we'll have like a gigantic collapse in the U.S. dollar.
Well, that's an interesting. It's an interesting take on that. Like, I never really considered it from that perspective. I do understand that we have leased out, we may have or may not have leased out so much of the official gold reserves. But I even just think that certain level that China's just been fundamentally underreporting how much gold they pull off their own domestic market and everything else for years. I mean, I remember Jim Rickards talking about this 10 years ago, saying that China probably has close to 6,000 tons right now. And that was 10 years ago. Just, looking at like the on balance volume, for lack of a better term, of how much they produce versus how much actually leaves their shores, yada, yada, yada. And then there's all the work that guys over at like Bullion Star do to try and figure out what's happening on the Shanghai Gold Exchange on a daily basis and all of that. I don't follow those sources anymore on a daily basis because I'm more focused on other things. But, just remembering that part of the equation. It's the same thing with the Russians. Like the Russian, none of the 280 tons of gold that the Russians produce every year ever hits the open market, or at least up until about 6 months ago, never hit the open market. They were just bought by the central bank using their trade surplus. They now finally are allowing those guys to actually sell that stuff into the market at a market rate. And I wonder if that's just actually kind of now going to China, right? As a let's see those couple hundred tons a year move over into Shanghai. So
another source of least supply that may be going to China is the fact that in GLD ETF, which is the biggest ETF, my view is that the authorized participants lease gold that they contribute to the ETF.
Sure.
And then they get the shares, and then they sell the shares to the public and keep all the money.
Yep.
Much better than management fees.
Oh yeah.
But the issue is when they redeem it, and have to do that, then they don't return the leased gold to the central bank. They sell it to China.
Right. Yeah, no. GLD. I don't think anybody seriously thinks that GLD is holding any stores. They're not like but what used to be the Central Fund of Canada with the Sprott Silver and Gold Fund, which used to be the Central Fund of Canada, who actually has a pile of silver. Right, that actually has a pile of gold and silver sitting somewhere in vaults. Right. No, they don't. GLD doesn't have it. So, and GLD's AUM has gone up by what, 50% this year? It's something ridiculous.
The GLD will have gold in the vault to show people that it's their gold, but there's an obscure rule in the IMF rules that when someone leases gold to a third party, title to the gold stays with the lessor, just like anything you may lease.
Right.
So the central banks still have a claim. So the gold sitting in the GLD is just there for show. It's not the GLD's gold.
Right. I think we're going to find out. I think the thrust of this conversation ultimately is that we're going to find out just how little gold there is out there. right?
That's
Over
right.
the course of the next, say, 2 years or so, and it's going to be a very interesting thing to watch. And I'm much more interested. I mean, I'm fascinated by this stuff, but I think that, and it's important. But at the end of the day, I think we've all, I don't know about you guys, but I internalized that this was going to happen at some point in the future anyway. It's just a matter of when it's going to happen and what the number is going to be. Because at the end of it, because the way I look at it is like, when I think about the history of this, right? And I think about the history of the gold standard and how it broke down, and I think about Bretton Woods, and I think about the end of World War I, and I think all those moments where people say, well, the gold standard didn't work for this reason or that reason. I'm like, well, no, if the Brits had, after World War I, had revalued, had taken the pound and valued it based on the amount of actual money in existence versus the pre-World War I standard value,
right.
everything would have been fine. If Bretton Woods, they had set gold to $100 an ounce, for example, as opposed to the pre-war $35 an ounce, things would have been more stable. But they didn't do that for whatever reason. They did, and that's why eventually gold had to prove to them that those numbers were wrong. And the French, of course, when de Gaulle crashed the London gold pool in '68, and we're into the scenario we're in now. The number on the upper end, I don't think really matters one way or the other. I don't think it matters if it's $7,000, $10,000, $20,000, $50,000 per ounce. What matters is that at some point, as Ira brought up, it's about the loss of confidence, and it's going to be a catastrophic parabolic rise that's going to force a policy action. The similar way that we had in '33 when FDR closed the banks and then did a 75% devaluation, and we had hyperinflation in the United States. Right. I mean, moving from $20 to $35 an ounce, that's hyperinflation. We did it in a month. It's like 12,000% hyperinflation in a month, annualized, right? So that's the way I look at it.
Well, and that's what they say, that a rising gold price is a loss of confidence in the central banks.
Exactly.
And, this is I know people will say, well, this conversation's moving, but it's not. It's a very important part of the conversation.
Absolutely.
And interesting when we talk about China, yes, they've definitely been hoarding gold. One of the things that I've theorized and put forth is, China was not on the gold standard. They were on the silver standard when Britain broke silver through the Opium Wars and the Boxer Rebellion. And
right.
a great sense of the history, especially of colonialism and its impact. So I'm waiting for the Chinese to go to a bimetal system and really take a look at silver, because they have a history of it. And what a way it would be to stick certain people pretty good. And now with the digital, are we going to see a digital backed currency? And I said, we're not going to the gold standard. I'm not saying that. But if I was China looking for more credibility, make my currency back 10 or 20% by gold. In today's world, it attains a lot of credibility.
Yep.
And that goes to an article which really got very little play, but it was an op-ed piece by Yi Gang, who's the governor of the People's Bank of China, EFT, almost 3 weeks ago. And he said in the article headline, the IMF should turn to special drawing rights in its COVID-19 response. I thought it was so interesting because I know who plays to China more than anybody, because it would elevate them in their importance and minimize others. Because what's the SDR? The SDR is it's like an international euro at this point,
right,
where it's supported by the underlying currencies, and that's all you're doing. But it would be a very interesting response. And I'll say this because there's all this conversation about how much the IMF is going to have to pick up here as the emerging markets come under more and more pressure, although the pressure is being relieved a little bit. And I know, Tom, this is something we talked about, because the depreciation, or the recent depreciation of the dollar, really does help them.
Oh yeah,
people, and even and Howell almost said it at his press conference. He couldn't quite get there because he won't talk about the dollar.
right.
But I'm sure that he's very, very happy in that regard, for that to be minimized, and that's a good thing. But that is one of those issues that weighs out there upon the world. And if the Fed, when Donald Trump stupidly and it's not a political comment that I'm making whatsoever. But when he talked about, a stronger dollar was good, that was back in May. I said, here's a guy who was only talking about a weaker dollar on a trade agenda, but now from a financial standpoint, and I'm only speaking financial, not talking about trade. The world needs a weaker dollar at this point in time. It needs
absolutely.
it.
Absolutely. The dollar hoarding is insane. I mean, the whole idea that the dollar is quote unquote weak right now is really just a function of the euro, of euro strength in light of their the COVID-19 relief package, a new budget, and the fact that they just gave the European Commission tax and spend authority. Right, that's what's driving that. But the rest of the world has been hoarding dollars, right? For like 2 years now, and they're continuing to hoard dollars. There's been a little bit of this hoarding in the last couple of weeks, but for the most part, it's the Treasury Department is issuing and auctioning off record amounts of debt at record high prices. And we haven't had a failure yet. We've had a little bit of a tailing auction here or there every once in a while, but for the most part, these have been some of the best auctions that the Treasury's ever run in the last month. Like, where is there no demand for the dollar? The world still is biblically short dollars because of all of the dollar denominated debt that was built up over the 12 years of near zero bound interest rates, and the dollar being the world's ultimate carry currency. Like, it's that's the thing we have to wrap our heads around. It. Yeah, the Fed's going to want to Trump and all of these, they're all going to destroy the dollar, and everybody kind of wants the dollar destroyed at a certain level, especially when the IMF, Goldman Sachs, and the CFR all come out in a week and say, yeah, the dollar needs to no longer be the world's reserve currency. Well, that's code for, and we're going to replace it with the euro or the SDR, or effectively some other internationalist version thereof. But that's got to happen after the dollar goes through a massive spike high and the euro has to crash. And there has to be another sovereign, and there's a sovereign debt crisis, and there's all the rest of it. These things, it has to happen in a particular order. And it's one of the things that I've been kind of banging on my shoe on the table about. Is like, it's not that the dollar is not going to be in trouble at some point in the future, but 2020 is not the year the dollar fails. I mean, this not yet, because there's too much synthetic short position against the dollar. I just don't see it yet. But
the present move has been really nothing. I point out to people this is nothing. It's I got into a back and forth with some people in the FT over an article about 3 or 4 weeks ago, and they said, the euro is garbage. The dollar is. I said, every argument you're making you could have made in 2008 when the euro went to 160. Right. Every one of those is an applicable argument. Mm-hmm. Why did it go to 160? They're all. We know that the if I hear that terrible phrase, the cleanest shirt in a dirty laundry basket, it's lost all meaning. It's a journalist. They can put it as a subheadline, but it really has no meaning. The dollar, and Powell knows it, and everybody sitting in that room. Richard Clear has been writing about it for a year and a half. That the Fed really, he won't say it as this, but it's the inconvenient truth, if we may say so, that the dollar, being the financial backstop of the world, gives the Fed a third mandate. And that third mandate was finally acted upon in a much needed way with the opening of the swap lines to 7 or 8 central banks who didn't have swap lines before. And if they had any more sense, they would have opened them to another 5 or 6 central banks who really needed it. But the world in which we live.
No, I agree. Absolutely.
The one thing that was in place before COVID, and it was the first time in my life that we had a simultaneous triple bubble in stocks, bonds, and real estate. And the stock market is miraculously held up and gone super exuberant. But that triple bubble is still about to fail, and that may come in the fall. And if that does, that's also going to have a huge negative impact on the dollar. But I agree with you, but these things probably won't play out till well into next year, and certainly after the election.
That's the way I look at it. And what I'm a little worried about right now is that the gold commentary industry, for lack of a better term, the gold punters, whatever, however you want to put it, and you be as respectful to the people as possible. But I'm a little worried they're getting ahead of themselves and they're talking the book a little too aggressively here. It's like I hate to say it. To me, it's just feels really disingenuous at this point in time. I mean, when I look at what I'm really worried about, and everything that we've all said, when you look at what's happening, I'm like watching the commodity markets literally as I'm speaking right now, and I'm watching the commodity ticker right now, and I've got to wonder, we're at this moment in time where we're going to have both demand destruction and supply chain disruption, right? All at the same time. We're going to have, and we've already had a commodity infrastructure that's been ground into paste over the last 10 years worth of a grinding bear market in almost all the metals and everything else. Now think about where we are. We're going to have cost push inflation. We're going to have stagflation in the United States. We're going to have 15% unemployment and rising commodity and food prices. And we're going to play that in at the same time as we've got massive monetary printing. We're going to have, it's going to be Arthur Burns on steroids, right? And what happened back then?
I agree. Yeah, 100%. No, nobody knows, but certainly it's a good bet that I agree with you that there'll be a pullback from the gold price short term,
right?
And it'll be a correction, as we always have, and then it'll carry on even at a more accelerated pace.
Exactly.
So that's a given.
Yeah. Okay. Just wanted to discuss on other aspects, like the regulatory factors, new aspects to the updated Basel Accord. Is that a factor, using gold as an asset by financial institutions to cover for unexpected losses? Your thoughts on that, Nick?
Well, it's clear that the central banks have been major buyers of gold, and it's not just China and Russia. So they've been building up for years and years now. The year 2000, they were all selling gold like crazy. Particularly the UK sale of gold at the rock bottom price of $275. Great move. But that's I think the central banks, like particularly of the Eastern European countries and Middle East countries, are building up their gold reserves just for that reason.
Tom,
I find it interesting, for example, that Turkey, for example, remonetized gold for all intents and purposes within its banking system. Like the gold flows through the Turkish banking system, and the Turkish lira is going to be probably the thing that blows up here in the next 36 hours, maybe. I don't know. It's going to be it's kind of crazy because Erdogan is got himself embroiled in a 5-front war and has now, I think, thoroughly ticked off both the Russians and the Americans and the Egyptians and the Greeks and the French and everybody else all at the same time, and he's finally losing control of the situation, along with Turkish corporates having an unbelievable amount of dollar-denominated debt that they can't service. But there's also a lot of official gold holdings in the Turkish banking system at the same time. That's been in place now for a few years. I'm interested to see what happens. And to me, the key is Central Asia, and has been for a while. It's going to be and it doesn't sound like important, but countries like Kazakhstan matter. And if I could invest in Kazakhstan, I would, right, at a retail level, but I can't. And they've been buying steadily for years now, as have a few other countries. Serbia is another one. Like everybody who's like trying to stave off Euro NATO expansion are like, they're buying gold to shore up their balance sheets, because Central Asian integration is the thing that's happening, is the thing that we're fighting desperately at a geopolitical level. The Trump administration is fighting it. So is, at a certain level, to a lesser extent, so is Europe. Certainly the Brits are. And I find that going to be that's going to be the most interesting battleground from my perspective going over the next 10 to 12 years. So,
the other thing that's interesting is Canada should get the the Moron of the Year prize for well,
No.
we have more gold in our fund than Canada has, and not only that they've sold it over the years by both political parties, and both were involved in the sale, and they're the one country that hasn't bought any. So we're
crazy.
Down below many of the third world countries that have no gold.
I mean, even Mexico's a failed state for all intents and purposes. At least they've been buying gold, right? I mean, it's But what's funny when we were talking about we've talked around the subject of the potential remonetization of gold. One of the things I always look at, just to note, is what the percentage of the gold reserves, what their face value of the stated gold reserves of the country versus M2. For a long time, the United States, up until recently, up until the current monetary spasm and the expansion of the Fed's balance sheet, hovered between 19 to 21%. The Russians have expanded their gold reserves and stopped buying when they got to around 20 to 21% of M2. And I think that if you're looking for a target for how much gold the Chinese are looking to buy or looking to announce finally that they have, I think it's going to be around that 20% level. Ira, you and I talked about. We talked about the potential for the EU to, swap out all of their current existing multi-denominational sovereign debt. The Italian versus the Spanish versus the Portuguese, and to swap all that out as a at a 15% gold cover clause and just reissue it as 15% gold back is a very that it's in that range. I don't think the market wants much more than 15 to 20% gold backing relative to the circulating real economy, not the credit economy, because the credit economy rises and falls, but the real economy, M2, as opposed to the credit economy, M3. So it's just one of those metrics that, if people need a thing to kind of look at relative to the balance sheet. And of course, Nick, you're right. Canada's at 0.02% or 0.002% at this point. It's kind of sad. And I hesitate to use the word pathetic, but it just is, because I love Canada, but you guys are being run by complete morons at this point. So.
Chrétien was asked in an interview by a reporter to explain why Canada has no gold and why they sold the gold. And so he says, oh, well, we don't need any gold. We got plenty of gold in the ground. It's like the mining companies.
It'll be interesting going back. We'll come full circle of this. When I read through all the nonsense that gets reported, and it's nonsense, and the IMF is crying that they don't have enough funds to deal with the rising problems of debt stress levels in the emerging markets. I go, why isn't the IMF off its gold hoard? It always the Make Work program for Keynesian economists of my age who went to the IMF and continue there amazes me that they hold on to gold like Charleston Heston wanted to hold on to his guns.
Right.
I don't get it.
I do.
They should be standing there going, okay, because I know who's going to buy it. Because, I go back to when the last big sale was the 200 tons to India in November of 2009, which irritated the Chinese terribly.
Right.
Because they were bypassed, and we didn't even talk about how much gold India is attaining. And that's all the jewelry, for the wedding season.
Sure. Ira, you touched on it earlier as to why they won't sell their gold. Because at some point, the SDR is going to become the world's reserve currency, at least in the short term. And again, we need to get back to how much can the IMF liquefy and bail out the central banks who fail? Because we're in the situation, we talked about it, right? At some point, failure, loss of confidence in central banks, rising gold price, exactly, and loss of confidence in the government institutions to pay back their debts. Well, at some point, all that sovereign debt that's going to fail. At some point, the IMF is going to step in, and how is the market going to be able to accurately assess the risk of that? Well, they're going to have to do so relative to the gold hoard that they've got. So all these I wouldn't even call them Keynesians because they're all Samuelsonians, right? Because Keynes would be rolling over in his grave if he actually is rolling over in his grave. Yeah, even Keynes is looking at what we're doing today going, y'all didn't actually read the general theory, now did you?
No,
That's right. You read Samuelson's textbook, which actually is nonsense. Got it. Okay, got it.
Yeah, and they paid attention to, because this is Nixon economics,
Right.
stage one. Because Nixon, he figured out, he goes, hey, yeah, I can get rid of this. When he said, famously, we're all Keynesians now, he understood it, but they missed the point that they're supposed to run budget surpluses during good times.
Right.
Convenient, there's another inconvenient truth. We'll get rid of that.
Well, for us, we can't do that because of Triffin's paradox, right? We can't do that because we run the world's reserve currency. So to liquefy world trade, nominally speaking, if you believe in Triffin's paradox, but that's the thing that they talk about, right? I mean, these are the things that go around. You get talked about in ivory tower circles for people who've never actually traded a bond or never actually lost money in the stock market. And I look at all this stuff, and I look at Bernanke, and then I look at Yellen, and I look at Powell. At least Powell comes from private equity, right? I look at these guys, and I think about the average flunky over at the PBOC has all spent more time in a bond pit, well, help than I have, and they're all sent out in the world to go, work at the trading firms, and work at hedge funds and whatnot, and actually trade stocks, bonds, commodities, and all the rest of it. Learn how the markets actually work, and then go back and do their work at the PBOC. Now, these people are communists, but they've all spent time in capital markets, which is why I think there's that whole, I alluded to earlier, there's that whole undercurrent of, when I look at the gold price, the chart of gold over the last 4 years since the 2015 low, all I see are the Chinese and the Russians coming in on panics and supporting the price at the levels that the COMEX and the U.S. and the West are uncomfortable with. That they gun for much bigger psychological damage to the gold market. And it didn't work, and they'd come in and they would buy at $50 or $100 above where they were supposed to. Because you can look at the chart; it's very clear: higher highs, higher lows on the monthly chart, all the way out until we get the breakout last year above the post-Brexit high at 1375. And when you look at that stuff, you just to me, it's so very obvious. We've been in a hybrid war with Russia and China since 2014. So to me, that's the gold is the weapon that they have available to them because it's the cheapest market to manipulate on both sides.
And you know what? That is a great point, and it's scary that nobody. See, Peter Bookvar brought this up after the last Apollo press conference, and I'm taking the media to task because the questions were inane. Who cares whether there's enough coins to go? Inane questions. Not one question was asked about the price of gold. It boggles my mind because I know this from somebody who used to meet with Volcker when he was Fed chair in an official capacity. And Volcker openly stated that he viewed, as a central bank chairman, he viewed gold as his enemy.
Of course.
Right? That's what I want. Now I'm stuck with a Fed chair who has now made himself the minister of social justice. As soon as he keeps reiterating that they've lost their jobs through no fault of their own, you're now on a path of social justice. Now, we all agree, and I think we would find commonality. I'm all about, I can't stand unemployment. I think it's such a disaster for people. But that's not I don't want my Fed chair, him, her, whatever, to say, well, through no fault of their own, because that binds your hands. You are now bound into a situation. And as I stated over and over, if I was blogging, I'd be screaming about it. We have to get to December. So we get to December, and let's say that hypothetically, unemployment is 9% and inflation on an annual basis is 6%.
Right.
Does the Fed raise rates? And you have to, and I think that's why the metals are really, getting geared up here, because they're starting to see the same thing. There's not a chance in the world. No. The Fed is lying through their teeth when they say they're concerned about inflation.
Yeah, no. The Fed wants it. The Fed needs inflation at this point.
They need it.
They're desperate. They're desperate for it, and they can't get it.
No, they can't get it.
Well, they can't get it and not kill the banks. We can get it. All we got to do is not pay interest on excess reserves, and then we can get it.
Yeah.
But they want to get it and not kill the banks. Always remember that.
But we have inflation, but it's in financial assets, not not inflation like the CPI index. That's where all the money is going, and that's driving the markets like crazy in terms of any kind of valuation approach of the markets. Grossly overvalued now.
Oh yes.
So, what about pension funds buying of precious metals, gold, silver, as an asset class for holdings? Do you see that beginning?
We've been working because we've started a new hedge fund that basically has the strategy of put 100% in gold until the market finishes correcting, and I expect the correction is going to be 50 to 70%. And at that point, you diversify into stocks, bonds, REITs, gold, and silver. So you end up with a balanced portfolio, but you've bought everything at the bottom. So we've been promoting that to pension funds because when we back tested this strategy for the 2008 crisis, we were getting 22% a year returns.
Right.
And pension funds prior to COVID were lucky to get 6%. And that's why you've got such huge unfunded liabilities. But it's an enormous struggle because gold is an asset that's just not on their minds. We've sold one pension fund, but a relatively small amount in the big picture. It was like tens of millions of dollars, but it was still a small amount. Mm-hmm. But other than that one Canadian pension fund, the Teachers Texas pension fund, which has less than 1%, and then there's a Dutch labor fund that has some gold. That's it of all the pension funds that I could determine.
It's interesting you say that, Nick, because that's pretty much the portfolio strategy I've laid out for my subscribers in my newsletter. Mm-hmm. It's well, with the exception of bonds, I think that sovereign debt is a real issue going forward. I think that what we're staring at is a sovereign debt crisis. So I've had people moving people into hard assets, obviously some form of land, be it farmland, some kind of REIT, timberland. As the areas that I've been looking at, and then obviously gold and silver, and then looking at energy assets at the bottom, or at least energy transport assets at the bottom, along with some other. I mean, obviously I've got a gun stock in there and a couple other things, but for the most part, that's kind of the way the portfolio is structured for the exact reason. Like at this point in time, you just want real assets. You want claims against real assets going forward.
I look at it from a kind of very fundamental point of view. Is that if you realize and understand that gold is real money, mm-hmm. and everything else is fake currency, then the thing is you start off with 100% in gold, mm-hmm. and in order to invest the gold and take some gold out of the vault, turn it into cash and buy something with it, the return has to be higher than gold.
That's right.
At less risk, and
yes.
virtually nothing is.
Yes, no, exactly right. And it was interesting. Yeah, well, that's the interesting part about it is that most people talk about gold as an investment when it's not. It's savings. Gold is just cash. Right. It's a savings. And then you have your investments, where you take on counterparty risk, and then you have your defense. You have your hedges, your defensive strategies to protect everything that you've got. And gold, goats, and guns, right? It's not a really hard thing, way to look at the world. The interesting part about this is that. What was I going to say? I lost my train of thought. Never mind. Richard, you were going to cut in. I'll shut up.
Oh, no. That's okay. Ira, your thoughts there?
Well, unfortunately, it went bye-bye. It went bye-bye, so I don't know what I'm going to do.
Okay.
I mean, we're touching on all the critical aspects. And to pick up for Tom, gold serves as a currency, the ultimate currency, because it's a fair value, and it is a medium of exchange until, of course, Roosevelt made it illegal, and then you had to go redo all those bonds anyway. So the bonds actually wound up taking a hit because they were tied into the gold clauses were all declared illegal. So I think those cases are still being.
So you're right, Ira. And the thing I think I was going to say, and I think it's come back to me, is that we have to realize that the general theme here is going to be loss of confidence in the political class and political institutions, which also translates into societal unrest and extreme anxiety on the part of people, which is why we have people screaming at each other over not wearing masks in public for a pandemic that is at best specious. And you have that general layer of anxiety about what to do. People don't know what to buy. They don't even know how to function, but they know they have no leadership. And when that happens, when there's loss of leadership at a political level, and you've got dysfunction, you've got open hostility and dysfunction at a political level, and that translates into the currency, and from there, and that's why I think sovereign debt is the big crisis to come, and that's the main driver of real assets and gold. And I think, and to a lesser extent, I also think stocks. You cannot count out equities as a claim against real plant property and property, plant, equipment. I mean, at a certain level, people still make things. Not Tesla, but they nominally make cars, but they don't actually. So,
Tom, that's
but these are all elements of the fourth turning, which is coming to pass. And the unfortunate thing is that we've got another 3 to 5 years to go before the end of the fourth turning. This is just the beginning.
Or more. I'm with Martin Armstrong. I'm thinking another 12 years of this. I'm thinking 2032. I'm thinking the end of the solar cycle. I mean, I've got a lot of other things that are going into this that aren't just the capital markets. I'm thinking in terms of the big stuff, like global. This is going to be This is going to be it for global warming and the whole 9 yards. There's a lot of stuff going on at a planetary level that feeds back into all of this as well, and is all crazy. But Ira, you were going to say something.
Yeah, we're just at this point, and with the point, having read the fourth turning only because, I believe in cycles. I believe in economic cycles, but the political cycles, I'm not as sure of, having read as much history and political science as I have in my life. But the fact that Steve Bannon was handing out the book made it a necessary read for me, because that if it's that important that you're giving out that book, it's definitely worth reading. So I did read it. Do I agree? Well, but I think is bias fitting, but that's okay.
Sure.
It was still an interesting read. Are we going there? Look at bad policy is bad policy. And people say, well, again, we return to gold. I said, I can make the rules. I can only react to the malfeasance of the policymakers.
Right.
And it's universal. It's all over the globe. Although now returning to probably and where we'll end is that I think Europe, as Tom started out the conversation, I think Europe made a very important step if they're going to stay as some type of federation, rather than a confederation or not even that much. So, and I think you're seeing that. So there became immediately, as I said, prior to, and I date this, and I think I did it with you, Tom, because I think it's on with Wolfgang Schweibel, Pivot, which was critical on May 24th that week, Memorial Day weekend in the United States. But when he pivoted from being Mr. Nine and fiscal austerity to understanding that the COVID crisis had caused far more havoc and was willing to grant and create a euro bond, I thought that now there's an alternative. And I thought that what we've really seen, and I think Nick's points too about a lot of this is in Europe. So when Europe got this right, it elevated all asset classes. Well, let's go back to it elevated equities, and it was such as that. That's what happened there. So very, very important. And I think the probability of a European dissolution dropped from 40% to 10%, because there's always a possibility that that Germany eventually says, no, I can't do this as a transfer union, I'm done. But I think it dropped so dramatically that it's given life to the euro. And you've seen from that day on, you can go look at a chart. I it as May 25th, we've had a 12-cent rally.
Oh, yeah. No, without a doubt. I remember the conversation that you and I had on my podcast. I listened to you very carefully that day. I didn't I didn't want to agree with you, but I wound up agreeing with you. Once you invoked the Schäuble, I was like, well, yeah, no, my argument fails, because I understood that point very, very clearly. But at the same time, I still don't still think that there's going to have to be another. They're not fixed yet. They're just on the way to being fixed. And one of the things that they have to now fix is how do they deal with Italy. I saw a great article on the Express a couple of weeks ago. Actually, I saw it through the Duran. The Alex and Duran did a great podcast on this, that Italy's got a massive funding wall coming in September and November. They've got a whole bunch of debt that's maturing right now in front of our eyes. And I don't know that they're going to be, and they're going to have to deal with that. And I don't know that there's going to be political there'll be the political will to get it done, but I don't know if it won't create a political crisis in Italy. What I'm worried about, and I've got an article that I'm working on, is whether or not that's going to cause snap elections in Italy and bring Salvini back to power, because it's very possible that it does. And then that's where, and then we have the Alexa party and forming and all of that stuff happening. I also have one other point on this, and I don't know that Merkel will ever let Italy leave, right? And I firmly believe she'll do everything in her power, like she already has, to keep Italy from leaving, and they'll put them under the austerity thumb. But they may not be able to pull that off. The interesting member of this, and I put this into your heads, one of my patrons talks to me about this all the time, is the possibility of Denmark leaving the European Union, a la the Brits did, because of the same reasons. They don't have their own currency. They don't want to be a part of it. They don't want to be a part of this transfer union. And the same things, the same dynamics that existed for the Brits exist for the Danes as well. And so if Italy, if in order to keep Italy, they may have to sacrifice the Danes, is the thesis. I'm not saying I agree with it. I'm just throwing it out there. Okay.
That's a very good point. And I will throw out a plug here, because Richard has been trying, it's not me, but Richard's been trying to do a podcast with myself and Bernard Connolly, who has a new book coming out. I don't know if you're familiar with Bernard Connolly, Nick.
I am.
But he has a book. I'm looking at the title right now, but he's been very busy. You Always Hurt the One You Love, Central Banks and the Murder of Capitalism.
Like, I have to read this. I'm like,
well, I don't know whether you read his first book. It was written in 1995, Rotten Heart of Europe.
I have.
It's an unbelievable book.
It is.
I'm really proud to call Bernard a friend. Anybody who wants a copy of this book, I have it in paperback, because my friend Bill Shepard and I brought it back. It was out of print and selling for $300, $400, $500 on Amazon. So we got Bernard to write a new forward in 2012, and we printed 10,000 copies. I've sold about 3,500, and I'm ready to close it out because his new book is coming out. So if anybody has copies, be my guest. You can email me. You can whatever you want. You can find me. I'll get you copies. But it's an important book, and it's an important discussion to have. So yeah, you're 100% right. This situation is not done, but for the good. I think Merkel walked back some major mistakes. I think Draghi put her in a terrible situation. I don't think she understood the situation, but I think the AfD did, the Alternative for Deutschland, and that was the original rise of it. And they were like the Tea Party because they were an economic phenomenon until they were successful. And then some of the other whack jobs who always come out of the woodwork, here's a successful group. I have some things in common with them. Let me attach my my success to them because they're getting the notoriety they get. So they had to overcome that. But it's an economic phenomenon. And I think she was really abused. She allowed herself to be abused by Draghi through the buildup of the massive buildup of the ECB balance sheet.
Absolutely.
And everything else that went with us. And that's where we reside right now. But Europe, I think, is a very important element in this discussion as we started at the beginning. So,
yeah, we're just running out of time here. Sorry, we could probably go on for hours, but how can our listeners learn more about your work if we can go around the table, Nick?
Well, we've published the weekly newsletter, the Bullion Buzz, and they can subscribe to that. And I usually pick out about six of the top articles in that. And once in a while, I add my own articles. So that's what you can keep up to date. There's an enormous amount of material out there, and whittling it down to six articles a week is a challenge. Mm-hmm. But that'll save people a lot of time and get you some essence of the what's happening around the world.
And Tom?
You can follow me over at my blog over tomluongo.me. It's or Gold, Ghosts, and Guns. I publish about 3 to 4 times a week there. I also do a weekly podcast, which is also published on the site. You can follow me on Twitter at TFL1728. And you can follow me also. I have a Patreon service for the newsletter and for private market podcasts that I do twice weekly on Wednesdays and Sundays to help people go through the technical state of these important markets like gold, silver, Bitcoin, the Dow, and anything you ask me to go over. So I'll do bespoke research for people as well, and all of that. So thank you.
Great. And Ira?
I just exist in this world where we go back and forth. I haven't been blogging, but I'm hoping to bring back Notes from Underground very shortly. I get emails all the time. People go, "Where are you? Where are you?" I said,
"Yeah, really, Ira. Seriously, please."
Oh, all right. I will. I'm getting ready to gear up. It's been a nice break for me, but I left off at a very nice time because I was very bearish the dollar and the metals. Tom, you and I talked about it. I've been on with Richard, probably ad nauseum for a lot of people, but moving along. So we will get this, and I just there's a lot of things to watch here. I think Nick laid them well. Tom always lays them out. There are just so many uncertainties, and people are complacent because the gold and the stock markets actually move right together. Not that there's a perfect correlation, there's not, but people are looking for alternatives. Also, as Tom said, trying to buy any type of assets that have a real underlying base, especially if you're getting a dividend play. So as I've been telling people, and I know Tom and I agreed on this when we talked, buying like Freeport McMoRan and the ag stocks, which have been so unloved.
Yes.
Why nobody sees them? As I talked about at the beginning of the year with Mark Faber, we talked about Bungie and now Archer Daniel. It's not farmland, but it's real assets and commodities which are getting a boost as the dollar starts to weaken, which is a long time relationship. So we have a lot to watch here. There are so many balls in play. And as Nick said, that's not even talking about what happened in Lebanon yesterday, even though we don't know what happened, but it can't be good for a very volatile region of the world.
Absolutely.
Well, it's been a fascinating discussion. Thank you very much, gentlemen.
Thank you for the invite.
Thank you, Richard.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.